Crypto realized vol explodes on the downside due to geopolitics, and put skew catches a serious bid. Key supports get tested but remain intact for now, as Israel's response seems delayed. With Bitcoin halving upon us and the Ethereum ETF approval looking less likely, option flows diverge. All this and more in this week's Crypto Options Unplugged. Hey everyone, welcome back to the show. I'm Imran Larker from Options Insight, and as usual, I've got Dave Brickell from FRNT with me in the studio. How's it going, man?
Yeah, good. Yeah, difficult market.
Yeah, crypto markets are a little bit on edge now, right? Bit nervous. We had some serious volatility last weekend, which I actually was trading around on a Sunday afternoon.
Well, I was thinking your short calls must have been working all right.
Well, no, I did some call ratios on the bounce, which looked really good on Monday when we had the bounce. They were like up, they almost doubled in value. But then as we've kind of drifted back down, they kind of haven't really made or lost any money. But it's just funny when the opportunities present themselves is when you have to get behind the screen and trade, and sometimes that will happen at the weekend in crypto. No,
absolutely. But obviously sort of a big flush on the geopolitics. I always typically fade like geopolitics, and I think you tend to get quite a sharp but short-lived sort of move. So I'm probably feel a little bit disappointed that we've kind of carried that through, but then maybe because we've not really kind of got any kind of resolution around
exactly
what's going to happen, but obviously big flash. The reason I think it's a fade typically is because war actually tends to lead to more debt. The US will have to spend more money, more military spend. That adds to this whole sort of like debt sustainability fears, and essentially leads to more money printing. You tend to get an easier Fed. The Fed will provide liquidity to support markets if they need. So actually, in a weird way, war can actually be quite positive for
I mean, I remember when I first started in the city, and I had my first actual book in 2003, I think it was. It was around about the Iraq War.
Yeah.
And you basically had a situation where I was new to the game, and like, the headlines are looking really bad, and the war is kicking off, and yet the market rallied like 10% in a day.
Yeah.
And I'm scratching my head going, what the hell is that? And all of the experienced seasoned traders were like, yeah, that's what happens on wars. Markets rally. Because what happens is when you've got the period of uncertainty where no one knows exactly what's going to happen.
Yeah.
The markets don't like that. So markets sell off into the uncertainty, but then when the war actually kicks off, that's when they just rip higher, because that cloud has been lifted and they just carry on doing their thing, right?
Yeah.
So I think similar sort of story here, like because that cloud of uncertainty has not passed, because we don't know what Israel's response exactly will be, and then the response to the response from Iran.
Yeah.
I think that is the uncertainty that's going to linger and make it very hard for markets to just rally back to the highs.
Yeah, exactly. And I think as well, what you get, like when you have like these VAR shocks, these value at risk shocks, you just get a broad de-risking. So, which is indiscriminate. You get a tap on the shoulder from the risk managers to say, right, you just have to reduce risk, even the things that you like and you want to put on. So actually, if you look, oil's down since the attacks.
I was scratching my head about that one a bit.
Yeah, but I think that's partly, there's probably a lot of long oil sort of trades on. And again, it's like VAR shock, just reduce all risk, even the stuff you want on. Even actually, I think it was late Friday, you started to see gold actually sell off a bit. Again, there's probably a lot of gold longs that had to kind of come out as well.
For sure. But that's been choppy now. Gold, after that move on Friday, it's been kind of chopping back and forth around that 2400 area.
Yeah.
But it does seem like metals are still the thing that is favoured right now, more than oil, for that geopolitical hedge.
I mean, one thing I'd say, like on gold, is like it definitely seems like obviously central banks have been sort of big buyers of that. So again, it's less kind of speculative demand than it is actual kind of real demand from reserve managers. So again, probably why you've not seen the same level of sort of selling off in gold. But yeah, like you go back to, even if you think of like March 2020 into lockdowns and whatnot, like everything sells off. Like, so there's kind of, you know, in those sort of big risk events, like all correlations go to one basically, right? And everything kind of sells off. And then once we kind of find that base level, then you start thinking about, what do I want to put back on? And then you start to see, you know, your gold starts to outperform. I think treasuries are going to be interesting, because I think we saw last year when the war with Israel and Palestine kicked off, treasuries actually sold off, because again, the debt sustainability fears, and it kind of fed into this idea that you know, the US are going to have to spend more money that they've really not got to be spending right now, but they're going to do it anyway, and that I think is going to be positive for Bitcoin. But I think right now we've just got this kind of de-risking. The Fed as well, they're still pushing this sort of higher for longer mantra. I don't actually think, like, stepping back, that it's actually such a big deal as we like push back these cuts.
But Powell was speaking earlier this week.
Yeah.
And he was decidedly hawkish, right? More than the market kind of thought.
Yeah, but I kind of, and I get the knee jerk to the market going, okay, this is a hawkish Powell, but I think so long as he's talking about rate cuts, which he still is, I don't think it's an issue. And in fact, what the Fed, or what Powell's telling me, and if you want to put the dovish spin on it, is that real rates are coming lower. So either real rates are nominal rates adjusted for inflation. So either inflation's going to stay higher and move higher, and then he's just going to be on hold. So real rates are adjusting lower via the inflation dynamic. Or if inflation comes off, they still seem pretty eager to cut and get rates lower. So as soon as you see inflation come off, then he's gonna sort of cut rates. So either way, I think real rates are coming lower. So I think we're in, say, a bit of a week where we're seeing this de-risking, a little bit of uncertainty still around what's going to go on with Iran. I think once we get through that, I think markets will recover pretty well. Another really interesting thing yesterday, which I'm surprised has gone a little bit almost unnoticed by the market, but obviously we've got the IMF meetings going on, and Yellen expressed concern around the yen weakness and Korean won weakness, and they kind of released a statement with the Japanese and Korean finance ministers. So that for me was interesting. We've spoken before about this. And I thought when Yellen went to China, and I haven't quite seen it play out yet, but that China needs a weaker dollar, because China needs to ease, because they've got this sort of deflationary economy. China also is seeing their biggest, competitor, Japan's currency, weaken significantly. So they kind of need to keep pace with the yen, but without wanting to destabilize their own currency, because they're battling all these capital outflows. So China kind of needs a weaker dollar to calm down, like the yen move. Obviously, Japan want to calm, they're concerned about their currency. Mm-hmm. Meantime, China and Japan are the biggest buyers of US treasuries, and Yellen's worried about the treasury market. So I still feel, and yes, these comments are interesting to me, that that there's kind of a deal to be done there. Okay, right, we'll help keep a weaker dollar. You keep buying our debt. And I think in the past, when we've seen Yellen make these sorts of comments, you've seen yields and the dollar top out. So it'll be interesting from here. And obviously we saw quite a reversal yesterday.
We did, yeah. We saw a reversal. We kind of hit quite an important sort of resistance zone. We got a strong 20-year bond auction as well. Yeah. We saw rates vol get smashed as well, right? Rates vol had been spiking pretty dramatically since this whole episode of high yield kicked off. Yep. And it's finally had a big one-day pullback. So, and rates vols, that's that thing that really drives cross-asset volatility all over the place.
Yeah, right? and when we talk about liquidity in markets, like rates vol and like the move index is a really important input into that, because that's like, bonds essentially are the collateral that gets used for taking leverage and all that stuff. So once you start seeing an increase in rates vol, then like the haircuts applied to that are bigger, so you can borrow less, and then there's less liquidity in the system. Obviously, as well, a sort of stronger dollar, the dollar wrecking ball is kind of a liquidity tightening aspect. So if we can see rates vol calm down, a weaker dollar, then that will kind of drive improved liquidity in the markets, and that's probably where you'll start to see sort of Bitcoin and bounce, and probably stocks bounce as well. So
Bitcoin halving is on Friday.
Yeah,
right.
Yeah.
So that's when this video will get released. So doesn't seem to have been the bullish catalyst that everyone was hoping for, right? Just yet. But like we've talked about it, it's not a binary event, right? But it's just funny everyone's piled into it before, and actually we're going through a period of weakness now on the week of the halving.
I think as well, like, I think we've been spoiled a bit this year in Bitcoin. Like we've had a really good move to start the year. At one point, it just seemed like up only. I think it's the first time we've ever hit record highs before the halving. So actually, it's been pretty constructive. And now I just think we're in this consolidation. The inflows into the ETFs have slowed, and I think they've been negative for the last couple of days. So, that kind of dynamics just died a bit flat. You've got this stronger yield and dollar dynamic just kind of weighing. So, yeah, there's some headwinds, I think, and we're just consolidating. I think it's going to be important that we kind of keep holding above this 60K level. It does. I mean, we discussed. It does feel like maybe it wants one more flush lower.
Because like this horizontal range between 60K and like 72K, and if that just carves out a correction in that and just holds it perfectly, it almost seems too easy, right? So, in fact, that's something me and so this week I caught up with JJ from JLabs. He's their derivatives analyst over there. So a bit different. Not my usual vol update that I do every week. He also looks quite closely at the options market. So we had a little chat about that. Don't forget to like and subscribe if you like all this content. So you get these videos, you get notifications, etc. Because Deribit also put out quite a lot of good other content for people who want to get in the weeds on trading these options. They've got a couple of traders from Rogue Trading Academy, I think, who do weekly videos as well. They don't quite go through the macro stuff like we do, but if you're a trader actively on Deribit, you're going to want to know what those guys are up to. Anyway, check out what JJ had to say. Hey everyone, I've got JJ, the JLabs Janitor, here to discuss crypto with us. How you doing, man? I can see
Good, how are you?
A very handsome avatar there covering your face, because obviously you can't really tell us who you really are.
It's a good looking cartoon.
Yeah, it's good, man. It's good. He's got his hands back behind his head, very chilled. Crypto market's not looking so chilled right now. But tell us, what do you guys do over there at JLabs?
So I'm the derivatives and option analyst at JLabs Digital. We offer various SMAs, separately managed accounts, services built on top of our autonomous trading system for trade desks, firms, high net worth individuals, do research and analysis. And we'll be launching our flagship product at Token 2049 this week. It's going to be Panda Terminal, crypto-centric trading terminal that's loaded with all the metrics we built over the years, everything from perps, options, on-chain data, token rating systems. That offers the ability for users to view all this data, create their own custom data sets, deploy trade algorithms, and high-speed execution for both on-chain and off-trades.
Okay, nice. Cool. So you guys are busy over there.
Very much so, yeah.
Yeah, so what are you thinking on this crypto market? Obviously, we're going through a bit of a correction right now. Seems like this kind of double whammy of inflation fear, yields breaking higher, and at the same time, we've got the geopolitical risk hanging over us that, are we going to go? I mean, no one really thinks we're going to go into World War III, but these guys, keep on escalating this issue, Israel and Iran. So it is a cloud of uncertainty that hangs over markets, and it's certainly the thing that got crypto markets moving last weekend. So what do you make of the current setup in the crypto market?
Indeed, it was looking like the market was just super heavy last week, right? Like we kept trying to break back over 70K after we lost it, and it just got to the point of where it was too heavy to hold anymore over the weekend. Then you finally had the catalyst event, right? So it seemed like the market was looking for a narrative to sell, and ultimately found it on the weekend news, and now we got this reset back down to what was basically the March lows. So if you look at that first all-time high break that we had back in March, and then the retest, fell back to this region we're in now. So it just seems like, so long as it holds, right, it's kind of a healthy reset for the market. We were talking yesterday, you and I, just about how frothy, especially in options, that massive squeeze that we had up to 70K, how much those premiums were going for, right? So we saw kind of this misattributed effect on the markets, whereas basically, if you looked at the data, it was kind of a large gamma squeeze that drove us up to 72, 74K. And then that effect had on markets was just a lot of FOMO chasing, right? Everybody wanted to be in before the halving. If you looked at some of those April contracts, like how much they were trading at, the 90K calls were going for over 10K, which was bringing us to an implied price of over 100K by the halving. And that was never really going to be sustainable, right? So we've seen a lot of that washed out in recent weeks. We've kind of been in this vol crush regime. Seems like options have been reliably finding like the max pain points over the past few weeks. So now we're kind of interesting, like there's a lot of spot bids that I'm currently looking at that are stacked up on Binance as well as Coinbase just below this current level. So it seems like support's there, but at the same time, if this gives way, there could be a lot of heavy selling.
So what, the 60K is kind of like where the support is stacking, but if that breaks, we got a potential move to 52K, something like that?
Yeah, that's what it's looking like. So I'm actually looking at the GEX right now on Amber data. You see that dealers are currently short a pretty large amount of 60K strikes. So if those bid walls fail to hold, we could be in for some turbulence here to the downside in the coming days.
Sure. And what about you guys? Do you have any of your own sort of proprietary signals that you generate and you look at to help determine what the market's going to do?
We do, yeah. So that's kind of generated by our AI, which is constantly scanning order books and on-chain data, off-chain data, just trying to generate signals.
And what are your signals? What are your signals showing right now?
I mean, those bid walls have been assigned a strength, but it's kind of right now we see the DXY sliding, which is providing some relief to markets. So if we see that continue tomorrow, obviously we have jobs data again. If that can weaken DXY, these bid walls hold. There's been a lot of shorts that have entered in recent days. So typically that's good for a bounce back squeeze in and of itself. Whether or not that's going to be enough to recapture that upside momentum above like 65 to 67K. That's really kind of what I see as the line in the sand is reconquering that lost 50-day moving average, which I believe is currently around 67. So if we can see a move back up above there, spot volume accompanies it, some call buying to add squeeze to it, and I think we could potentially be in for all-time highs in May, but it's all relying on getting that momentum back in a very short amount of time here.
The funding rates come back down. They got very elevated, right? In like 30% type levels. The futures funding basis, that's come crashing back down a bit, right?
Yeah, there was actually negative funding over the weekend as well, which is notable. We saw one of the largest liquidations since basically FTX back in 2022 take place. So there's been a lot of froth washed out, like that cash and carry trade was so popular for so long. And I think Athena, when I'm not sure if you've been following that, but they basically launched the token that it acquires yield by running this cash and carry trade, and that kind of marked the top of the cash and carry trade. It seems those funding rates got washed out within days after them announcing that. So it seems like some froth reset here, which is ultimately healthy for continuation.
It is, yeah. It makes me feel good to hear that you saying that there's been quite a lot of water flushing out of that type of froth. And then what about flows in options? You mentioned the big open interest for April on the 60Ks, but are we seeing a lot of May and June? I mean, I know what I'm seeing in Amber data, but what about you in what you look at? Are you seeing much call buying going on? Like there's some May call buying came in this week on the 69K strike. What do you make of that stuff?
Yeah, that's been interesting. There's been a lot of activity in those May contracts. And that basically started last Thursday. Like as soon as those last week's contracts rolled off, the May call buying started to go ballistic. I think we saw a rise up from somewhere around 7K last week of open call interest, and now it's currently over 20K of open BTC notional. So obviously a lot of activity into there that was driven in large part by that 69K buyer who I think it was a few $1 million of premium he put into those rates. So
yeah, it's a chunk of premium. I mean, I personally, I think that's a better play than owning April because, you know, it's not like that halving event is this binary event that, I mean, the halving's due to happen in 2 days, right? But so that's going to be on Friday, I think, the halving. Is that set in stone that it's going to be on Friday?
I think so, yeah, the 19th.
Yeah, so then it's not like just on Friday suddenly, okay, market needs to gap 5-10% higher just because of the halving, right? It's a well-telegraphed thing that's happening. But if it's a case of, you know, we do get that reduction in supply and the market gets through these current sort of issues that it's got with the geopolitics, then you should start to just see the kind of natural demand start to take us higher because supply has been reduced. And, the miners have been banging out a load of their coins recently that they were hoarding. You've had the inflows, you've had the front loaded inflows from all the ETFs that went in before the halving. But then you got to think that just in general, there will be ongoing inflows throughout the rest of the year that come. And those inflows, if they're met with less supply because of the halving, then we should see prices drift higher. It doesn't have to be it doesn't have to be so explosive, right?
Yeah, it's never a binary event the day of, right? Like the halving, that effect takes a while to price itself into markets, but ultimately I don't think this ETF demand is going anywhere long term. And you add into that the decreased daily supply, like it just kind of creates this perfect scenario for price to ultimately lift off and accelerate in the future, especially once these macro fears that we've been discussing, like obviously the higher inflation reports led to increased or decreased rate cut expectations, a higher DXY. So that's really having this drag effect on the market. It's caused the sell-off, which if things reverse now, it's quite bullish, right? We kind of have this 60K retest, and if this is in fact the bottom, this has to be kind of...
I mean, it feels to me like it's a bit too easy. Feels like it's a bit too easy if it bounces straight off 60K and it has that perfect consolidation in like a parallel kind of trend channel, or in a parallel sort of channel where it just like marks out a nice textbook correction and doesn't... I would think that it wants to spook a few people out and maybe have one last flush lower, but remains to be seen if it does. But whatever happens, I agree with you that it's probably a dip buying opportunity anyway. All right, before we sign off, what are your thoughts on Ethereum? Well, obviously, it's kind of suffered a bit in terms of had high beta to the downside. It had a bit of there was a bit of rotation into Solana. That had an incredible run, but that itself has had quite a correction as well from its highs. Do you think this Ethereum ETF May deadline is just not happening, but it's probably already priced for it not to happen? And do you think it's coming later this year? And would you be a buyer of ETH down here at around 3,000?
I don't think it's coming in May, but I ultimately don't think that matters too much. Like we were discussing, we probably see some like kind of news event driven sell off when that finally does happen. The market gets its release point. You see some kind of algos jump on. The release that news.
Yeah, disappointment that it doesn't happen in May. We get a little dip, and that's your opportunity to load up, basically.
Yeah, very much so. And I think traditionally, when you look at ETH, the way it performs after BTC's halving against the BTC pair, like ETH BTC has probably a bit further to fall. Maybe it goes down to 0.04, 0.035.
Yeah, I mean, it's broken a big support level, right? So in theory, it should go a bit lower, given that level was in place for so long and it's taken it out. Yeah,
exactly. So I think you'll finally see that capitulate. Maybe BTC's up above 80K at that time, right? If it recaptures momentum here, runs a bit, you could see ETH kind of stagnating, especially after that announcement might sell off a bit further. And you see that capitulation in the ETH BTC pair. You'll see it in the volume, right? So you watch the volume on Binance and Coinbase, and once people finally capitulate their ETH in the BTC, that's probably the time to be a buyer and get your hands on some ETH there for the long term.
I mean, ETH for now has definitely picked up its beta. It went through a period where there's loads of call overwriting and it was just kind of swamping the street with gamma, and that was kind of making it hard to move. ETH wasn't managing to realize. Certainly picked up on the downside, that realized. But yeah, I guess the question remains is if Bitcoin does bounce off here, does ETH go along for the ride? Personally, I think it will go along for the ride because I think a lot of people will look through this May deadline now. No one really expects it in May. So people are kind of looking through that. So I do think it will maintain its beta even if Bitcoin bounces. But I would love to see a flush out on the downside where that ETH BTC cross really gets hammered and provides you quite a lot of juice to step into that trade.
Yeah. If you look at the volumes on it too, just the ETH BTC pair, you could look on Binance or Coinbase, and there just hasn't been a whole lot of volume basically since the merge. So like since that pre-merge trade kind of took narrative, like people were really jumping out on that. There was a lot of FOMO that ETH would just outperform forever. And now it's underperformed. So I think we need to see some kind of equal capitulation candle volume on there. And that'll be your signal that, hey, the bottom's in on here. It's going to run. And I think we're in for new highs probably by the end of 2025 or so. So
no, cool.
Opportunities there.
All right, man. JJ, been a pleasure having you on. Where can people find you? You're on X, right?
Yep, at JLabs Janitor, and twice a week on our podcast on the YouTube channel at X Changing Good.
Cool. And you write a newsletter as well, right?
Yep. You can find all those links in my bio on Twitter as well.
All right, man. Thanks for the chat. Catch you next time.
Good talking.
Okay, yeah. So another sort of lens from the options market.
Yeah, and perhaps kind of in keeping with our conversation that maybe there is another flush to come.
Yeah, he seemed to think his indicators and that weren't really suggesting that it's an imminent squeeze we get from here, right?
Yeah. So I think caution, I think is the word right now.
Yeah, I mean, I'd say opportunities wise, rather than just jumping in on the buy side, maybe the opportunities in just owning Ethereum vol against Bitcoin vol, right? Because like that realized on Ethereum's massive now. It's at 100. It's been realizing 100 plus on a 10-day basis.
Yeah.
Because it's definitely got its mojo back. Remember when Ethereum never used to move because of all the overwriting flows swamping the market with gamma? It's definitely moving on the downside, right?
Yeah.
So the question is, will it move on the upside? We don't know, but because there's a risk that we break lower still, and that ETH Bitcoin cross has broken key supports, I think just owning a bit of Ethereum vol delta neutral against being short Bitcoin vol kind of gives you access to that puke scenario without really committing to it.
Yeah. No, that make a lot of sense. And within that, like, what kind of sort of maturities would you look at?
I'd probably just go 2 to 3 months.
Yeah.
Right. Not too short, not too long, and just basically something that's got a bit of vol and a bit of Vega and a bit of gamma on it. And you can just sit on, and it's got quite a stable gamma profile. Because the thing about, if you trade too short dated, your gamma is very concentrated around the strike that you pick.
Yeah.
So if the spot's not around that strike, the gamma dissipates really fast.
Yeah.
So you don't actually have the position for very long, right?
Yeah.
But if you go 2-3 months out, then you can pick like a strangle or something that's kind of 5-10% plus or minus where we are now. And that gamma is going to stay with you for a long period of time. It's going to be a very stable profile. So I think that would be the way people should probably look at it.
Yeah. All right, interesting. It's funny as well. I mean, I don't know. Before we came in the studio, I saw something about talks about Genza resigning. I don't know if that's just hopium from some crypto bros, but that could be interesting as well, because I think we'd probably get a reaction around that.
You reckon?
Yeah.
Interesting. Yeah.
Yeah.
But it seems the option flows are telling a bit of a different picture as well in between Bitcoin and Ethereum. So right now we've got, whilst the weekend puke obviously created a massive put bid on the front end for everything.
Yeah.
So you had like both Bitcoin and Ethereum put skew in, like weeklies go to like 10 vol plus for puts. Over the last few days, as we've kind of stabilized a bit and we've held that 60K support and we kind of dipped below 3,000 on Ethereum, but then popped our head back above again. It's interesting because you've seen some bullish flows on Bitcoin. So you've seen some put spread selling on Bitcoin. You've seen some call buying. People I don't know whether people are thinking that the halving is going to do something tomorrow or whatever. But the point is, out to end of May, people are starting to show a little bit more optimism to try and buy the dip on Bitcoin. But you are not seeing that at all on Ethereum. So on Ethereum, you saw like large chunks of June put spreads bought last week. They have not been monetized, even though we dipped below 3,000. But they're like the 3,000 put versus the 2,500 put. So they're not exactly in the money yet.
Yeah.
So you wouldn't want to monetize them until they went properly in the money. But then you had loads of call sellers as well in Ethereum, 3,500, 3,600 in April. So I think it's just like that's suppressing, that call selling is still there. And the fact that people are buying put spreads rather than outright puts means that the Ethereum vol isn't catching the sort of bid that it normally would do, because people aren't just buying outright options. If people bought outright options, the Ethereum vol would be trading 10, 15 vols higher.
Yeah.
But the fact that they're not, you've got realized at 100 and you've got implied at 70 odd. So you've got this massive spread because people are just almost a bit scared to buy too much outright vol in the 70s because they kind of got some memory of how low it can go. They're scared. But for the people who actually just trade vol and trade what's in front of them, looks like a really good opportunity owning some ETH vol.
Yeah, and like you say, if it's realising and you're not sort of bleeding on it.
Because I don't think we're just going to sit here.
Yeah,
right?
yeah.
You know what I mean? We're not at a level where I think ETH just goes to sleep at 3,000.
Yeah,
right?
yeah.
It either breaks and then, we get a bit of a panic move, or we get a resolution on the geopolitics and we could fly again, right?
Yeah, and like, again, for me, we were saying about like the move index, and if rates volatility calms down, certainly if the dollar was to reverse, and that would kind of be improved liquidity in the system, And I always think like the alts and like Ethereum will kind of be the start of that moving out of the risk curve, and then you could have a really like decent move. And yeah, it's interesting. It's completely unloved, isn't it, right now? Like ETH.
Yeah, I mean, what do you make of that theory from JJ that we might get this disappointment dip on the ETH ETF not passing in May? Do you think there's any anticipation whatsoever about that?
I don't think anyone's expecting this to pass in May.
So you don't even think we get like an algo driven dip?
No, I don't think we will, and I think if we do, I think it'll be quite short lived, because the other thing that might come from all of that is it starts putting it back on the agenda for a future.
It gives you another date, because right now we don't have another date to like focus on, right? Yeah. That's true.
So yeah, there is a chance that again you kind of get past that, and then we can start like putting it back on the sort of narrative. But
probably September, October time, maybe they roll it to. I've no edge on that at all.
Yeah. Me neither. And it'll be interesting. I mean, you listen to Larry Fink. He still thinks this thing gets done. Like either way, so it'll be interesting. And also as well, you've got the in Hong Kong, they've approved the spot ETF for Ethereum.
They've already approved it.
Yeah, so I think that's quite interesting. I mean, I was asking the Bloomberg guys, like, does that like influence their expectations for for a spot ETF in the US, and they were like no, don't see why. But there is like that kind of regulatory arbitrage type thing. I imagine if you got BlackRock sat there going, right, well in Asia they've got the ETF. Why are we not doing it here in the US?
Yeah.
So I just wonder if that maybe has some sort of influence. And then I mean, as well. That's going to be really interesting to see what sort of inflows those ETFs in Hong Kong get. There's a lot of money out in Asia, and again, the ETF market is actually pretty small generally, like for equities and stuff in Asia. But we kind of underestimated the strength of the flows into the ETFs in the US. So it feels again like people are maybe underestimating that a bit, but it could be quite a significant driver. But so yeah, there's a few things going on. I think the market feels a bit flat at the moment. And yeah, even though there's lots of these things bubbling under the surface. So
I mean, look, all markets have periods of consolidation, right?
Yeah.
Especially after they've gone parabolic, like the way they have this year, right?
Yeah.
I think this is very much so far. It's a very healthy correction, right? It's nothing too sinister. I mean, I've definitely unwound some hedges on that puke last weekend.
Yeah.
Because even though I do favour we probably go lower from here, that is like a short-term phenomenon, and the rebound out of it could be so fast that I won't get to monetize my hedges anyway. And for me, the more important position to be holding is the long-term long position.
Yeah.
So I want to be in a position where I'm not levered, I've got my exposure, and if we do get another dramatic dip, which like stops people out, then I can dip my toes in and gear up and add some length. But I don't really want to just hedge it here and then, miss out on the actual long-term trade, which I believe in, basically, right? So
yeah.
Kind of how I'm looking at it.
Yeah. And it's funny as well, like price is narrative often, right? So, we by the time this goes out, we could have reclaimed 65k in Bitcoin, and then everyone's talking about all the positive stories around things. So I think it's going to be really interesting with following Yellen's comments yesterday to see how the dollar and yields trade. And I think if we start to see those calm down, I think that could be a trigger to start sending us higher. But yeah, right now the longer we go without bouncing and reclaiming those levels, then you feel like it will just flush at some point.
So I guess
short and sharp. But
so I guess the message to take away from this episode is still constructive longer term. We're going through a bit of a period of consolidation. Clearly, the clouds have not lifted on the geopolitics yet. So don't be levered. Don't be in a position where a knee-jerk move down is going to stop you out of your holdings for the long-term trade. But I think you want to just kind of step back and just let this play out, or you want to be in a position where if we were to get the dip, you'd be able to add some length and take advantage of that opportunity, because fading geopolitics generally does tend to work. It's just that you've got to be a bit cute, a bit careful about how you time that so you don't get stopped out. All right, that is it for this week's episode. Remember, like we said, like and subscribe. That will really help this kind of new podcast get more traction, and that will kind of help us grow, and then you can get this kind of content more regularly. All right. Thanks for watching, guys. We'll catch you next week.